Welcome to my channel. Today we will be talking about the best type of financing for restocking inventory on Amazon. When you're running an Amazon FBA business, restocking inventory is where cash flow gets tight. You need capital to place that next big order, but your sales revenue from the last order is still tied up in Amazon's payment cycle. From my experience, the best financing isn't one specific product for everyone. It's the one that matches your speed, cost, and repayment flexibility needs. I've used a few options, and I can tell you which ones generally work best for restocking. 1. Amazon lending or platform-based advances. If you're a proven seller, the first place to check is Amazon lending or similar offers from third-party fintech companies who integrate directly with your Amazon Seller Central. The pro, it's fast. You're usually approved based on your sales data, not just personal credit. Repayment is often automatically deducted from your Amazon payouts, which is incredibly convenient. I got an offer for a quick-term loan right when I needed to stock up for Prime Day, and the speed was a lifesaver. The con: the interest or fees can be higher than a traditional bank, and you are more tied to the Amazon ecosystem. The loan might also be a lump sum, which can be less flexible if your inventory needs change. 2. A business line of credit. This is what I consider the gold standard for ongoing inventory management. The pro: it offers revolving credit. You only borrow what you need when you need it, and you only pay interest on the amount you've actually drawn. It acts like a powerful business credit card, but with potentially lower interest rates and higher limits. It's perfect for the recurring need of restocking, because you can use it, pay it down as Amazon pays you, and then draw from it again for the next order. It gives you incredible control over your cash flow. The con: the application process might be a little longer and require more detailed business financials than an Amazon exclusive advance. 3. Revenue-based financing, RBF. This is a great option if your sales are consistent but fluctuate seasonally. The pro: with RBF, the repayment amount is tied to a percentage of your daily or weekly sales. When sales are high, you pay more. When sales are slow, you pay less. This flexibility is crucial because it keeps you from defaulting if a shipment is delayed or a sales event underperforms. It's ideal for bridging the gap between placing a huge seasonal order and getting the full sales revenue back. The con: the overall cost of capital can sometimes be higher compared to a traditional loan or line of credit, and you need a solid, verifiable sales history to qualify. Ultimately, for pure, efficient restocking, I found that a business line of credit provided the best balance of flexibility and control costs of my ongoing needs. It lets you treat inventory as a consistent, revolving expense, which is exactly what it is in the FBA business. With that being said, thank you for watching. For more finance videos, kindly check my page. Please like, share, comment, and subscribe to my channel. Thank you.